What's up, everybody? I'm Courtney. I am the host of the Financially Free Journey channel, also the podcast. And today I'm going to be answering your top 10 questions when it comes to investing. So let's go. Make sure that you just go ahead and subscribe. So then that way you can get the notifications the next time I post a video. But let's get into it. Go ahead and start with question number 10, which is, what are blue chip stocks? I like this question because this is really one of the top questions that people always ask. What are blue chip stocks? Blue chip stocks are stocks of companies that are widely known, like Berkshire Hathaway. They're usually safe when it comes to investing. They have great returns and equity growth over a period of time, and it's usually in large cap stocks. So when people refer to blue chip stocks, they're referring to this list of companies that have been successful and consistent with the returns of their company, and they are usually large cap. Let's go to number 9. Love this question. Number 9 is, what is day trading, and is day trading for me? So day trading is essentially the complete opposite of a long-term passive investor. You've got passive investing and active investing. When you're an active investor, day trading is a form of active investing. So what does that mean? It means it's a very hands-on approach. You're watching the charts, you're watching the movement in price. You are buying into and then you're selling stock over a very short period of time, and you're usually capitalizing on the volatility of that stock. So like a swing trader, for example, you are looking for a stock that dipped in price, and then you're watching the charts for that price to go up and then sell it quickly. Sometimes day traders are only holding onto stocks for a matter of minutes or seconds, just depending on the volatility of that stock. So day trading is something that is risky, especially if you do not understand how to read charts. You don't understand the difference of growth versus value stocks. And it's something that people do when they are very versed in the market and they understand the analysis portion of trading. So if that's you, then day trading could be for you. This question is, what is hedging? This is a term that a lot of people in the investment community use, but not a lot of regular everyday people understand the term hedging, rightfully so. I mean, there's so much about investing that can be complex and can be intimidating, and a lot of that derives just simply from the terminology. So hedging, let's just put it in simple terms. It's a way to buy insurance on your investment positions. So this is where you buy derivatives of an investment to protect against the risk or the volatility of that investment. If risk is something that you are concerned about when it comes to your investing strategy, looking into hedging against your investment positions is a great way to be able to mitigate that risk and to bring it down. So look into derivatives or ways to hedge the investment positions that you currently hold. The next most asked question when it comes to investing is, I currently hold a student loan balance. Should I pay my student loans off, or should I start investing now? This is a conundrum for a lot of people, especially the millennial and the Gen Z generations, because we have the largest load of student loans of all generations in our society. And so that burden of having that student loan debt can seem almost, where it's going to hold you back, right, from being able to live the life that you want, to be able to get the finances that you want, to become financially independent. And this is a very personal decision. And a lot of the decisions that we make when it comes to paying off debt, it has to do with how it emotionally impacts us. So you need to ask yourself, how does your student loan debt emotionally impact you? Is it something that keeps you up at night? Is it something that stresses you out? When you think about your student loans, you get a little bit of anxiety in your chest. If the answer is yes, then paying off your student loans may be the best option for you. But if you want to talk logically or analytical, you want to run the numbers, you can ask yourself this question: what interest rate are you paying on your student loans, and what return could you expect to get in the market if you were to invest that money instead? Now, you have to remember that paying off debt is a guaranteed return. You know, if you pay 5.75 on your Sallie Mae student loan debt, that you are getting a 5.75 return on your money immediately, no questions asked. If you are to invest that money into the market, there is no guarantee that money could completely plummet, right? And if you don't do your research, that's absolutely a possibility, but there is a lot of upside potential. So you need to be able to run those numbers and logically assess which one makes more sense when you're looking at the numbers. So I think taking into account the emotional impact that the debt has on you, as well as the logical aspect, the financial aspect of running the numbers and seeing what position will it put you in to pay off your student loans versus invest, and then make the decision for you. I can tell you personally, it's been important to me to invest now when it comes to debt. Now, I'm not talking high interest debt. Credit cards, things like that needs to be paid off immediately, no questions asked, because that can get you in a bad position. But when it comes to fixed interest rate debt, that's not considered high interest. For me personally, time is of the essence. Time is one of the most important commodities that you have when it comes to investing in the stock market, because your returns compound over time. Not only is your investment appreciating in value when it comes to the actual investment, but you're also having time work on your side, and exponentially that continues to increase. Next question that is asked the most is, I keep hearing the word diversify. How do I invest in my portfolio and make sure that I'm diversifying? How much should I put in stocks versus bonds? Love this question because this is going to be different for everybody, but there's a really simple way for you to figure out the exposure to equities you should have versus bonds. So let's go over it. Touch on first and foremost that diversification is critical because you don't want to put all your eggs in one basket, right? So the way that you do that is to make sure that you don't have all of your holdings into one company, right? So you got to diversify within the stock market, within your stock and equity portfolio, but then you also need to diversify into a different type of investment class. And that's where you can look at bonds, you can look at money market, you can look at real estate. There's a lot of different opportunities to diversify outside of the equity market that's going to hedge against risk. And depending on your time horizon, how long you're invested into the market, that's going to determine the exposure that you should have to equities, because we all know that equities have the highest upside potential, but they also are the riskiest. So how much should you invest into equities? That's the question, right? So here's some simple math for you. Take your age and deduct it from 100. And that's the percentage of your portfolio that you should have exposed to equities. This is a great rule of thumb within the investment community to help give you an idea of how much equities you should hold within your portfolio. But of course, I would say that that's just a rule of thumb, and you really do need to enlist the advice of an expert, financial advisor, someone who is able to run the numbers and also understand your specific needs. Because just because you are, a certain age doesn't mean that your needs and what you're desiring from your money and your investments is going to be the same as every other person your age. But that's a general rule of thumb of where to start and do some research and then talk to a pro. I really want to start investing. Should I look at picking individual stocks? If so, how do I decide which stocks to pick? Let's talk about it. If you are a beginner, and in this question in particular, I am starting out my investment journey. How do I pick individual stocks? My opinion is that you do not pick individual stocks. You look at buying into mutual funds and ETFs, which are like a basket that holds tons of companies inside of it. And so you're getting the upside potential of all of those individual companies, but you're not getting the risk associated with investing all of your money into one company. Because let's just give an example of, let's say you invested in a very large retail company, and then it comes out that retail company is, they're outsourcing all of their production to another country, and they're underpaying in wages. When that hits the news, then that company is going to take a big dip in the value of their stock, and you could lose money. But if you're invested into hundreds of companies, that dip that company takes from that news is going to be very slight in your overall portfolio. So you're hedging against the individual or unsystematic risk that's associated with being invested in one particular stock. How much of my income should I be investing? So as a general rule of thumb, you should be investing around 20% of your income for your future. So this is also taking into account that you have an emergency fund set in place, you have all of your high interest debt paid off, and then now you're on the path to financial freedom, building your wealth through investing. So if that's where you're at, a general rule of thumb is 20%. Now, that may vary depending on when you want those funds to be available to you. If you are on the FI journey where you're wanting to be financially independent early prior to the normal retirement age, then it may be a lot higher percentage than that. So you want to take into account the time horizon that you've set for yourself and then do the calculation that way. But if you're just getting started, general rule of thumb, 20%. Next top question that people ask when it comes to investing is, how do I know when I should sell stocks I'm invested in? Well, isn't that just the million-dollar question? But let's talk about it. So the age-old adage is that you should buy low and sell high, just like with any type of transaction that you do. You want to be able to make a profit off of that margin from the price that you bought it to the price that you're selling. But psychologically, what happens when it comes to investing a majority of the time is people buy high and they sell low. So what do I mean by that? A lot of people that are getting started when it comes to investing, they get their investing advice from people that are maybe family, friends. You're sitting around at the dinner table, you're at a cocktail party, and someone mentions that they bought into X company, right? When you're family and friends and you're at a cocktail party and they're talking about investing in a particular company or asset class, that's typically not the best time to buy into that. And the reason why is because the volume will drive up the price in the market. And once that happens, you're going to have an inflated value when it comes to the actual price of the stock versus what it's worth. So that's where a lot of people get into this conundrum. They bought in when there was the hype, and then once the hype comes and starts settling down, then people get that panic and anxiety, and then they sell low because they want to cut their losses, right? And this is the complete opposite of what we know logically we should be doing when it comes to investing. What you need to keep in mind is that you need to look for buying stocks at a discount. So what do I mean? I love analogies. You walk into your favorite clothing store and you see your favorite jeans on sale. They're 30% off. Well, you were going to buy those jeans at full price, but now you're getting a 30% discount. So what does that mean when it comes to investing? That means that you should be looking for stocks that are undervalued. So then that way you can see the potential and you'll get that rise in price. So you need to be able to understand, how do you look at the value versus the price? But that's a whole other video. The next and final question that I got asked a ton when it comes to investing is, what are some investing red flags? Let's get into it. Just like your mama or your grandma told you, if it seems too good to be true, it is. And that applies to investing tenfold. If you have someone tell you that there's no risk, beware, because there's always risk associated with investing. Investing is inherently risky. So every single type of investment has its own risk associated with it. So make sure that you're an informed investor and you don't just have your rose-colored glasses on, but that you look at the investment for what it is. There's going to be risk and there's going to be reward. And you need to make sure that you're taking the appropriate risk and reward that you feel comfortable with, and you make an investment according to that. Another red flag is that if you can't explain the investment to a friend, you probably shouldn't invest in it. Warren Buffett says this all the time, but don't invest in things that you can't explain at the dinner table and have it make sense to other people. You need to have a good understanding and be an informed investor. So do your research. Don't be paralyzed by doing so much analysis that you don't pull the trigger, but make sure that you are fully informed and you don't have your rose-colored glasses. Make sure you're looking at the investment for what it is. And if you're diversified and if you have the right amount of exposure to the market, then you're going to be mitigating that risk and you're going to come out great and strong on the other end. But look at the investment for what it really is. Okay, whoa. So we just covered a ton of information. Comment on this video. Let me know what questions you have, or if you have any follow-up videos you want me to make where I expand on the topics a little bit more for you guys. But if you're not already, make sure that you check out the podcast. It's Financially Free Journey. You can listen to it anywhere where podcasts are available to you. And make sure you're following us on TikTok and Instagram. It's at Financially Free Journey, where I help you achieve your financial goals. Until next time.